Good afternoon. Welcome back for another REIT webinar with Hoya Capital. Today, my name is David Auerbach. I'm the Chief Investment Officer of Hoya Capital, and I'm excited to be joined by my longtime friend, REIT industry colleague, and concert touring buddy, Stephen Rodriguez, the REIT Portfolio Manager at American Century. Before we start, Steve, in case you didn't notice, I busted out my Section 119 fish donut dress shirt just for you today, my friend.
Wow, very nice. I'm honored.
So American Century's asked us to share this little disclaimer compliance slide so we could satisfy the compliance requirement. I can tell you this is much shorter than the original compliance slide that we had up on the presentation. American Century, for those that don't know, manages over $300 billion as of 12/31 25. 2 billion of that is in REITs, and they highlight the ownership structure. Stowers Institute, Nomura, American Century. Stowers, fantastic story for those that don't follow it. Check out the American Century Celebrity Golf Tournament that occurs every summer. And what Stowers has done is just a great, great story and partnership there. Steve, Steve, like a couple other guests we've had in the past, came from Lehman back in the day. Um, He's been American Century since 2009, works with a very, very well-known REIT analyst, Steve Brown, for those that are following and know Steve from back in the day, uh, and graduated University of Michigan. As if I didn't say it already, congrats on your UMich hoops win this week. Very exciting. There it is. So with that, Steve, let's just jump right into it. I'm going to turn off the slide. There are a couple of slides we'll come back to and refer to in the presentation, but my goal is for this to be a nice interactive dialogue between the two of us. And obviously with where we sit today versus the previous month, couple of months, past several months, past year, et cetera, it seems like everything changes on a day-by-day basis. But because American Century is a global firm, what can you tell us about global real estate performance so far this year?
Yes, thanks for that question. And Dave, before I start, thanks for having me. It's been a long time. I'm happy we're able to make this happen. This is a great thing that you're doing for the sector, for the industry, and for all of us involved. You're a great man to do it, and the perfect man to do it, if I may add. So
Thank
global
you.
listed real estate performance. So it's been a pretty strong year, both on an absolute and a relative basis. Year to date listed REITs, we'll go to yesterday. Today they're up another 2%, but as of yesterday, we're up about 4% year to date. That compares to global developed equities down one and bonds, global equity bonds, which are also down one. But generally, it's important to note that that's actually on a relative basis, that's performance is consistent with what we've been telling clients in terms of in line with our expectations. And our expectations effectively are that listed real estate is set up to offer much better relative returns versus the broader equities market. And it's really a function of just the risk reward from a valuation perspective. And then when you stand on top of that, the earnings profile for a lot of listed global real estate securities is improving and accelerating, given moderating to very little new supply in a lot of sectors, in most sectors. It's setting up for a very strong backdrop. And then from a valuation perspective, we're trading at kind of multi-decades low relative general equities. So the relative valuation outperformance doesn't surprise me, especially since there's some increased uncertainty in terms of how AI and other parts of the market are being affected by that.
You have this great slide in your year-end note that walks the reader through why REITs, why now. So I want to spend a portion of our conversation time today, if you can kind of go through bullet by bullet. We'll start at number one, we'll go through number four, and use that as a launching pad to, again, highlight why REITs, why now. So let's kick it off with the first one here. Rates peaked in fourth quarter of 23, thus inflation should remain anchored. Inflation has moderated, shelter inflation has more downside,
Mhm.
economic growth slowing, wage growth, private employment moderating, but expected to remain positive. Unpack.
Yeah, so this is a slide that's been on our deck really since late 2023. where we've been talking to a lot of clients since then, telling them that we believe in late 23, we were at the precedent of a restart of the real estate cycle. And back then we had, 3, 4 years of absolutely terrible performance on REITs, both on an absolute and relative basis. But we were telling individuals that, listen, there's a few common themes from the bottom of all real estate cycles. And one of those ties to a significant moderation and or curtailment of new supply. And we started to get that in 2023. Additionally, by the second half of 2003, if you focus on kind of what was going on the inflation front and what the central banks were doing, we and the capital markets started to gain confidence that as time turned elastic from a federal funds tightening perspective, the market definitely was expected to start seeing the lag effects of tighter monetary policy in 22, and that was going to work its way through the market in 23 and 24. And so with those two kind of linchpins, we were telling our clients that it was to get back on the train and listed real estate was going to produce pretty solid returns going forward. Now think about what's happened since then. Listed real estate has produced mid to low teens total returns since late 23. That's very strong returns in line with the beginning of prior real estate cycles. What's different in this cycle versus other cycles is the S&P general equities has produced even better outsized returns at greater than 20% in terms of the ACWI equities across the globe. And so, yes, listed real estate has produced very solid returns since the bottom, but we start the real estate cycle. We say the real estate cycle in 23. But yes, general equities has been better. But we believe that all that does is it sets us up for a better risk reward today than we've had over the last few years.
I think it's what 60% right now, 60, the outperformance of S&P to where REITs stand. Granted, we've
Hmm.
finally started to eat into that gap just a smidge, but obviously there must be something more than this to get us over that hump and really start making a push into eating that outsized performance. Wouldn't you agree?
Yes. And so exactly. Let's kind of double click into some of these bullet points here. So in terms of one, I've highlighted that inflation has began to moderate for really last several years, and there's various anchors on that inflation. And it's important to bring up what's going on today. Today, and we'll talk about this a little bit later on, but in terms of the conflict in the Middle East, that's likely, and we expect that that's going to put upward pressure on inflation. But there's various anchors on inflation out there that's going to keep inflation, in our view, somewhat range bound. And that's going to allow the capital markets to act appropriately. Another anchor on inflation is really economic growth is slowing. If you look at the GDP now estimate because of the elevated oil costs today, GDP now, which was call it 3.5%, 4% a few quarters ago, is expected to fall all the way down to the 1 to 2% range. And then lastly, if you look at wage growth is moderating. So there's various anchors of inflation that's going to put an anchor on top of this upward inflationary pressure of energy costs. So that's why we're less concerned on inflation into the medium term with what's going on. And then point two here is really accelerating earnings growth. And I alluded to this earlier because of the limited new supply that we see in effectively 85% of our investable universe across the globe. The other 15 is really data centers, and we'll talk about that. But the 85%, you're seeing a lot less new commercial real estate supply. And so you couple that with steady demand, that results in better pricing power and better earnings growth. And so we expect to see and we've seen accelerating earnings growth from 24 to 25, and we expect that to further accelerate in 26 and 27.
Before you jump into 3 and 4, where I really want to spend some time digging into it, it's very encouraging to hear what you're saying in bullet point 2 about lack of new supply. If
Hmm.
you recall, I just did this webinar a couple of weeks ago with Alex Goldfarb from Piper Sandler, and at least 10 different times in the conversation, he mentioned the boon for REITs to give us the tailwinds we need is the lack of new supply. When you talk to
Yes.
Stephen Yaloff from Tanger, and he mentions, David, there's no new retail supply that's out there. Thus, our existing real estate becomes that much more valuable tomorrow than it is today. So it seems like this lack of new supply is really the main driver to kind of focus on why REITs right now, it seems. At least a lot of people more and more people are starting to mention that.
100%. So, I mean, if we take us back though, you can't just focus on supply, focus on demand and supply. But today we have greater confidence in supply moderating. So that leaves us with the question on how do we underwrite demand? And demand, all else equal, is pretty steady. And we could talk about the different sectors. On some sectors, it's accelerating more than others, but that's going to result in steady to improving bottom line earnings growth. And that's really what we need to see for that valuation disconnect to start to work in its favor for the REITs. And we're beginning to see that today.
Let's talk about number three, because I feel like you guys are taking it from a multiple different perspective. You're looking at multiples as well as NAV. And unless your name is Welltower, unless your name is Public Storage, unless you are a data center REIT at this point, many of these companies and sectors are trading at discounts to NAV. And so I'd love to get your thoughts on why NAV looks attractive, especially when it's right now, again, for so many of these companies, their stock is not a valuable commodity to get
Mhm.
a deal done because of the stocks trading at discounts.
Yeah. So your question on NAV. So NAV is in terms of just the math today. We trade closer to about a high single digit discount to NAV across the globe. That varies by region and sector, as you highlighted. A few companies trade at premiums, some significant premiums to underlying NAV. And historically, we compare that high single digit discount. That's on average over time, it's a low single digit discount, if not on top of NAV over time. And so that provides some upwards pressure on capital values in the listed real estate stocks. So when you think about the capital value upside with the earnings growth that's accelerating to mid to high single digits, and then layer over in 4% dividend yield, that should result in a low double digit total return in line with what we've seen really since late 2023.
Walk us through the public versus private side of the equation.
Yeah. So historically, I mean, if you think about commercial real estate, listed real estate market is a small subset of the broader commercial real estate market. Listed real estate's maybe 15%, 15 to 20% in total. And so we're a small subset. So we have to kind of understand what's going on in terms of trends in the private market to really understand what's going on in the broader real estate market. But it's important to note that when we think about return potential for listed versus private real estate returns today, especially where we are in the real estate cycle, historically, the first half of the real estate cycle, you tend to see significantly better performance from listed securities than private securities. And there's a few reasons for that. One, there's the discount mechanism of the public market where today's stocks, they're forwardly discounting securities, where they're going to think about what's going to occur over the next several years and discount that into the price. And you're going to get that. And then good management teams with that proper cost of capital will use that cost of capital to also grow on top of that, those core fundamentals. Another reason why you're going to see better performance for the listed REITs versus the private in the earlier years of a real estate cycle is balance sheets. Today, listed real estate balance sheets from an LTV perspective are between, call it 30 and 40%. On the private market, that's between, call it 50 and 70%. So what that means is the listed companies can be much more aggressive in putting capital to work at the beginning of a cycle to get better returns on that capital over the course of the cycle. Meanwhile, on the private side, you're seeing a lot of funds and a lot of assets that have elevated leverage that are really trying to grow into its leverage, really not being able to do anything with their balance sheet or their capital today, and just hoping for the market to recover. Listed real estate can do that and then some.
We sat through the Blackstone acquiring a bunch of REITs coming out of, coming out of COVID. And that was back in the free money days when money was pouring into that vehicle. And not going to knock Blackstone, don't want any cease and desist letters from John Gray and Mr. Schwartzman. But now that we're in a different cycle than where we were just a couple of years ago, a lot of these publicly traded REITs are going to be sitting on the other side of the table from Blackstone, potentially buying these properties. At least I think so, as Blackstone works to refinance some of those deals that
Mm.
they did. Would you agree?
Yeah, that's exactly what's happening. So Blackstone is a ginormous commercial real estate owner of assets. So, and they have funds in different vintages. So depending on whether they're buying and selling effectively is a function of the different funds vintage. But at the end of the day, they have been large sellers of assets over the last 2 years, some of which have been to listed REITs for those private vehicles to fund some of their dividend and near-term capital needs. And so the listed REITs in the last 2 years have actually benefited from some of those situations where Blackstone's had to been a net seller. But going forward, refinancing a lot of this debt is also going to be a headwind for a lot of these private funds, and Blackstone's seeing that today.
Now, before I jump into a couple of your sector picks that are standing out, going to throw you a little bit of a curveball. We at Hoya cover 20 different subsectors. And as we like to say, each of those 20 subsectors, including some of the stocks inside of each of those subsectors, could be going through different stages of the real estate cycle themselves. And so as a result, as a global firm, let's ignore the US for a second because we're going to talk about the US ad nauseum. But for somebody who's looking at this potentially from an international's perspective, what are some of the sectors that are jumping out globally that may not be standing out, let's say, domestically? And then on the flip side, what are some of the sectors that are standing out domestically, which we'll get into, that are not standing out globally necessarily?
Yeah. So that to me, that's a fastball, not a curveball. It's right down the middle. I'll take that one. Uh, so so let's talk about sectors that are doing well in the US, that are not doing well, or we expect them to do well kind of in the near to medium term, but they haven't done as well outside the US. And that the perfect sector there to talk about is really data centers. And if you think about the timeline of how AI has accelerated capital deployment into data centers over the last few years, it's this chart shows it perfectly. So if you think about in 2022, we call it the Nvidia moment when they blew out numbers and beat, I think it was 4 billion in a single quarter. That was the beginning of capital deployment inside the US. And you started to see very elevated levels of capital investment by the hyperscalers and others inside the US. And you could see that here in that chart on the bottom, where US capital started aggressively growing starting in 22 and really accelerating massively in 24, 25, and this year. That has benefited companies such as DLR, Equinix, Iron Mountain, various private vehicles inside the United States where there's a ton of development. And that development, though, is getting leased up at very strong returns, benefiting bottom line for a lot of these data center companies in the US. Now, think about outside the US. As part of our investment process, we talk about where we look to identify sustainable trends. And when we have identified something, our next natural question is, well, is this a global trend? Is this a local market trend? Is this going to move over into Europe and Asia? And so we had those conversations in 22 and 23, and we weren't seeing it yet. We were speaking to other technology companies in Europe, other technology companies in Asia. And in 2022, we weren't seeing that acceleration of capital investment. Fast forward to today, we are beginning to see a pickup in capital investment in various parts of Asia, led by some Chinese companies and other Asian technology companies, and even some US companies that are now growing outside of the US to Europe and Asia. And companies such as GDS, an Asian-based data center company, is benefiting from that tremendously. Also, companies in Singapore, there's certain data center companies in Singapore and even in Spain that are all benefiting from this capital investment that started in the US years ago that is now going global, benefiting some of those companies more so than the US companies today.
Let's throw a little 9 inning, 9Q baseball analogy at you. What inning would you say we are in terms of data centers right now?
It's a great question, and we talk about it all the time. So from it's the answer to that question. I don't really have an answer to that question. The answer to that question is really, when does demand slow from a capital deployment perspective? And some will tell you that as the way we've been looking at it is capital may slow from an overall capital deployment when you think about the hyperscalers CapEx numbers. That may level out, but the type of capital that's being invested in LLM type data centers relative to inference type workloads, that may transition over time. And you could see winners and losers of that type of capital invested inside data centers over time. We're not there yet. We're at the early innings of that inflection in our view. But if you think the broader data center cycle view in terms of what innings we're in, it's a hard question. Yeah, it's a hard question to answer because really, I don't think the middle innings to if I had to give you an answer.
Perfect.
But what we're
Let's
focused on
focus
is the
on.
inflection point to inference, though.
Let's look at a different sector that you guys say are standing out: senior housing. Get in
So
line.
senior
Seems like
housing.
every sell side firm, every buy side firm, finally everybody is very bullish on senior housing. Give us your thoughts
So
there.
yeah, so within our investment process and in terms of our philosophy and how we think about the world, we're always looking to identify sustainable economic trends that could either benefit or disbenefit a sector and or region. And so we feel as part of our process, we've been identify some over time that have benefited our clients. One of which has been healthcare, senior housing specifically. We've been overweight senior housing companies, especially in the US, but now so on a global basis for several years now. And it goes back to demand and supply. And demand, as we know, the demographic tailwinds and demand has been there for some time. But if you go back pre-COVID, supply was more elevated than it is today. Today, there's actually no new supply. If you look at this chart on the right here, for a variety of reasons, new supply in seniors housing has dwindled to a level that is very problematic in the sense that the supply is just not going to be there in the next 5 years. When you think about the 80 age cohort, 80 age cohort is likely to double between now and 5 years from now. And that's going to produce a tremendous amount of demand. But when you think about new supply that's being built, it's just not there. And so it's a structural overweight today within our strategies because we believe it's a sustainable economic trend that's going to benefit a lot of these companies over the next several years. Now, the difference here, though, between the US and other markets is over the last few years, while the US has accelerated, Europe has taken a little bit more time to accelerate for regulatory reasons. Uh, and so they've kind of gotten through some of those reasons. And so for the first time, we went overweight some healthcare assets in 2025, where we were looking at them for several years, but there were some regulatory issues there. So it took us some time to get comfortable with regulatory issues, especially in France and Germany. And as we got more comfortable with that and certain companies kind of fixed their issues from a regulatory side of things, then we got more optimistic on the industry and the region.
Let's start looking at some broad questions. We had ADP come out earlier this week. We had a pretty strong jobs report come out on Good Friday. How does employment growth benefit REITs in your eyes?
So employment growth's probably the most important metric, economic metric. So you really have to focus on it to really invest in real estate today. It's important to note that. So employment growth relative to our expectations, it's actually come in better than feared, given a lot of the fears out there in terms of AI and what it's going to do to hiring practices. And it's been better than feared in many global markets, including the US. It's important though to decompose that, really look underneath the hood and what's driving that kind of strong employment market. And it's that really tells a lot, a big part of the story. So for example, last week, I think US non-farm payrolls is kind of 180,000 range, expectations were 60. But if you look under the hood, it's really healthcare, education, and leisure. If you take out the first two, the trend is relatively negative in white collar job growth. And that's more problematic. So kind of what does that mean? So when you think about overall employment being better than expected, that's relatively solid and good from a consumption perspective. So good for retail oriented real estate, uh, good for industrial oriented real estate that might be directly or indirectly tied to consumption. Because as you see higher employment, lower unemployment, you tend to see good retail spending behavior by a lot of the public. However, that's different from an office perspective. From an office perspective, when you kind of decompose it and realize white collar job growth is not doing nearly as well, that's not going to benefit or fill up the Class A and Class B office assets we see out there. And so employment growth is doing very well, but really when you look under the hood, it's one of the structural reasons why we're underweight office today, where we are seeing a uh, kind of a moderation in white collar job growth, and that's going to be a headwind toward office demand today. Now let's talk about residential. Residential is a little bit more complicated because it's not just employment or white job employment. So overall, when you think about total employment, that's a positive for residential demand. But there's a few headwinds out there. One, there's less migration today. There's increased unaffordability today in terms of the inflation we've seen over the last several years. That's kind of put pressure on the wallet share that individuals can pay in terms of rent. Additionally, there's something going on in terms of the boomerang generation, where because of the unaffordability, you're seeing more young adults live or move back home with their mom and dad. And that's an additional headwind for demand on residential product. And so we're a little bit more concerned on residential demand today. The stocks from a valuation perspective are relatively cheap, but we're unsure on the near-term catalyst and seeing that pricing power inflection because of the demand headwinds.
Let's put a bolt-on question there since you talked about it. It's home affordability.
Mhm.
And, we have this issue in Washington trying to work on single family rentals, build to rent, build to own. What's your guys' view on the potential legislation? Do you think the single family rental REITs will be impacted by this? Now, I can give you our stance on it. We've been very vocal about it, but curious to hear what your thoughts are there.
So it's clearly a risk. It's a political risk that we have to include in our underwriting and our outlook for the names. We are underweight the sector, and it really there are a few different reasons. One, if you think about my kind of conversation earlier on headwinds of pricing power, that not only multifamily product, but that's going to affect single family products as well. And you're seeing that in terms of the rent spreads on asking rents are moderating in kind of the near to medium term. And then you have this political overhang risk. And it's hard to kind of caveat that, include that in our analysis to be confident with an investment.
The other big 800-pound gorilla topic that seems to be kicked around a lot is good old AI. So, does AI help our industry? Does it hurt our constituents? What's your thoughts about AI and REITs?
So like a lot, it depends. So your first question is, does it help our industry? And I mean, it does. It helps our industry in different ways, and it hurts different sectors in different ways. But if that's the question, does it help our industry? It does. I mean, earlier this year, I saw a great term called the halo trade. I'm not sure if Goldman or whoever else came up with it, but hard
Josh
assets,
Brown,
low.
downtown Josh Brown.
Exactly. He's one. Yeah, I wasn't sure if it was him or Goldman or whoever, but hard assets, low obsolescence, and that's exactly what real estate is. You're going to see the uncertainty around the level of disruption that AI is going to have across a lot of service businesses, really across all businesses in the economy. It's have varying degrees of impact. One thing we know though is a building that people can either live in or have positive retail experiences in or work in, that's not going to go obsolete over time as long as they're reinvested and funded well and from a capex perspective. And so we believe the free cash flow that's being generated from those assets that we're seeing from listed real estate, that you're going to see a better light shine on these assets, and we're seeing that this year in terms of the level of outperformance. And so I think this halo trade, which effectively started because of the uncertainty around AI, has legs in terms of benefiting capital value appreciation for real estate. Now, if you kind of double click and think about the different sectors, the office tends to be on the negative side, tends to be the most talked about sector. That will companies need to lease all this office space if they're more productive? Um, it's interesting because I noted earlier that white collar job growth is definitely under pressure today. But when you look at some of the markets where you're seeing the best migration trends from a demographic perspective, such as New York City in the States, such as Tokyo, such as London, you're actually seeing positive rental office growth. Um, in all those markets. And the common denominator is those are cities that young adults want to live in, limited new supply. And then when you think about the leasing activity in each of those markets, you're seeing large and medium-sized corporations commit to long-term leases at very high rents in Class A buildings. And so if you think they were concerned previously uh, or concerned about AI affecting their businesses, I mean, they're showing long-term commitments, and that's benefiting those office markets, and that's going to benefit to the stocks over time. And we're seeing the office names do better in those markets.
I got Mark Holliday and Stephen Roth calling me right now. They want to talk to you and say thank you because that's what they've been talking about recently. So just want to pass it along that Holliday is trying to get in touch with you. That's, I think, a very salient point.
I
And go ahead.
Yeah, I wanted to come back. Earlier, you asked a question on what's not working in the US that's working outside the US. I never gave an answer to that. And office is actually the answer to that, where we are structurally underweight or underweight office today. We're picking our spots in the US, but in markets such as Tokyo, we're seeing a very, very strong tailwind in commercial real estate fundamentals in Tokyo. And so we're actually very overweight many office names in Tokyo. And it's a variety of reasons. One, they have the demographic tailwinds in terms of young adults moving there. They have the corporate investment, business investments occurring, limited new supply. And then lastly, from an idiosyncratic standpoint, each of these companies are improving in Japan, are improving their corporate governance, allowing for the valuation to reset higher. So there you have fundamental tailwind and multiple upside tailwinds because of improved corporate governance. And so that's an example that's working outside the US, but not working in the US.
Are tariffs still an issue or is that ship sailed?
It's still an issue, but most of it's, in our view, has kind of worked its way through the system. From an inflation standpoint, it definitely has worked its way through the system. We don't believe the average weighted average tariff rate is going to go higher. We believe a lot of that's priced in, and that's why, from an inflation standpoint, we're not that concerned. We are still monitoring various retailers to see how it's affecting their margins, and so from a tariff perspective, we're focused more on that in terms of retailer margins.
Do you think we can wake up tomorrow and twist around in a new situation here where, again, we had the news that came out today that countries that are supplying arms to Iran are subject to a 50% tariff. So again, do you feel like it's still a take it a day by day approach, or overall it's played itself through?
I saw that headline today. My first thought was the same thing. Well, how is this going to affect weighted average tariff rate? And then I started thinking about which countries supply Iran relative to sending product here. Outside of China, there's not that much overlap in terms of friends of Iran versus us. So that's definitely something, as you said, day by day that we have to think about in the near to medium term.
So I want to answer this next question thinking out past 2 weeks because we have
Mhm.
this market situation here that's bought us 2 weeks of, we'll call it potential relief. But let's say nothing has worked out in the next 2 weeks. How do you see this conflict impacting the REIT sector going forward?
So effectively, you're painting a backdrop of continued conflict, elevated conflict going forward.
Let
Uh,
me let me let me let me couch my words. Let's hope that something gets resolved in the next 2 weeks and we go back to
yeah,
where we were 6 weeks ago when our sector was finally humming along and things were going great. But if not, what happens if we're right back in the same place that we were
yeah.
yesterday and this continues on for 3 months, 6 months, a year, or longer? How does that impact our sector?
Yeah. So if I take it back to our investment process, we have kind of a two steps in our investment process. One, we're always trying to look for sustainable economic trend that's going to disbenefit or benefit throughout an economic cycle. And when you think about data centers and healthcare sectors and trends that we prefer today, we preferred for several years, we believe both of those will continue to outperform and provide very good total return performance against kind of an elevated conflict situation that just continues into the medium term. Because what's going to come with it is likely going to be continued capital market volatility, continued inflationary pressures from higher energy costs, and we haven't seen it yet. But in your scenario, not my base case, but in your scenario, maybe that could lead to a curtailment or a moderation of business investment, and that we haven't really seen that in the last 6 weeks. But if that does occur, yes, you could see GDP fall to a level that could be problematic. Having said that, our base case is oil costs stay relatively elevated, maybe not as high as they were, call it last week, but they do stay relatively elevated relative to where we were 6 to 7 weeks ago. The conflict definitely takes a step lower. I'm not going to say it goes to zero, but it definitely takes a step lower so the market can kind of move forward. More importantly, businesses can move forward with their strategy of whatever business it is in terms of their investment plans. And in that situation, we're probably operating in a lower GDP environment, led by kind of a lower consumption environment because of the higher elevated energy costs going to eat in a little bit that retail thing. And so you're seeing that in the GDP now metric, where GDP expectations have moved to call it the 1 to 2% range, down from a 3 to 4% range a few months ago. The good thing is as that's moderated, we are seeing year to date the benefit, especially in the US, of lower taxes. Tax refunds are up 14% year over year. And so that elevated level of liquidity is offsetting some of those higher energy costs today, allowing for kind of continued positive retail consumption in the US and other markets.
I want to take a little bit of a different answer than you did on this, though. I'm not saying it's party time and everybody celebrates all around, but in the past 6 weeks, we've seen several REITs issue debt. We've seen a couple of secondaries. We've seen a couple of M&A announcements. In fact, a public-to-public deal that we hadn't expected to see in quite some time. Granted, it was one of those companies trading at a premium to NAV, as we talked about, in Public
Mhm.
Storage, acquiring National Storage. But I guess my pushback to you, and Debbie Downer or not, but it's been business as usual for the REITs. They've put the blinders on, they've ignored the macro. The 10-year never got to 4.5%. It was able to maintain a band between what, 420, 440, it seemed, in this past several weeks. So I feel like for a lot of these companies, we can't control what's happening overseas. So let's focus on business as usual and just keep doing what we're doing.
I agree. I mean that speaks to my comment that we never really saw moderation business investment. Companies move forward with their strategy. If this continued to remain at a very elevated level in terms of the conflict, maybe you would start to see that, but we have not started to see that. And so what that means is the strong economic trends that we've experienced going into the conflict, some of that's continuing to benefit today's economy. And that's allowing for steady demand trends. And when you take those steady demand trends and couple it with very low, little new supply, that's positive pricing power and positive earnings growth.
You talked about dividends briefly, looking at your dividend. You talked about, I think you said a 4% dividend. What's your thoughts about REITs and growing dividends in the future?
Yeah. So as I noted earlier, so we are seeing earnings growth accelerate. Uh, they accelerated in 25. We see that in 26. And that's going to correlate with dividend growth. So we expect dividend growth to be mid to high single digits in terms of a dividend growth perspective per share. And the reason why we have confidence in that being in line or better than earnings growth is because when you look at the payout ratios for REITs, that's the best thing they got. Payout ratios are relatively low as a function of dividend over the free cash flow or the AFFO per share. And so that gives a lot of comfort in a lot of companies growing their dividend per share in line or better with their earnings growth.
I would also push back that they haven't been as aggressive with dividends as they were pre-COVID, that they have retained capital for a rainy day, take advantage of offensive opportunities when they present themselves. What do I do with this extra penny? Do I pass it through to my shareholders? Do I keep it on the balance sheet for a rainy day?
100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. 100%. Yeah. So the payout ratio is below long-term averages. So you're correct to say that they could get more aggressive in having dividend growth greater than earnings growth. But another thing is they could also buy back shares. A lot of the stocks trade at discounts to NAV today. And so whether it's dividend payouts or buying back shares in terms of capital return programs, both can be accretive today for many valuations of listed REITs.
So you have spent a few minutes talking about your process, and I pulled down some data here from you that about 4 or 5 slides worth that talks about the process. So for those that don't understand, how institutional managers think, can you walk, and again, I just want to set the stage for you
Mhm.
so you see the philosophy, your top-down, bottom-up approach, regional sector, company level. So walk us through this whole process, if you will, please.
Yeah. So our philosophy is you need to have a top-down analysis of geographical regions and property sectors. And you need to think about that to identify a sustainable economic trend that could benefit or disbenefit a sector and region. Now, if you're able to identify certain trends, that could really put you in a much better position in terms of stock selection. A lot of times we can't, but over time we feel we've been able to identify trends early, whether it's e-commerce and consumption patterns in various countries, whether it's seniors housing, whether digital infrastructure. And by the way, when I talk about e-commerce, that was a very significant sustainable economic trend that benefited one sector and disbenefited other sectors. And we felt when we positioned the strategies, portfolios on both sides of that and benefited that from that for several years. Um, that's really part one of our process, as seen here. Step one, try to identify some real estate market fundamentals that are sustainable over time. Step two of our process is really looking at our universe from a bottoms up framework and using a blended valuation approach. And when you think about our blended valuation framework, what that means is we look at both price to NAV as well as earnings growth. And then we weight all the companies across both those metrics and look at a weighted average rank. And that's really how we think about risk reward for each of the companies within our framework. And the inputs into that framework are seen here in terms of asset quality and manager quality, two very important qualitative measures. We are sustainably integrated. And then most importantly, balance sheet and earnings power being inputted into each within our evaluation framework from the earnings models for each of our companies. And that results in a risk reward from a valuation perspective that allows us to either decide to put it in the portfolio or not put it in the portfolio. And the execution of that process has produced very strong total return performance relative to our benchmark and relative to our peers over time.
Why is sustainability so important when we're seeing let's say, a push away from sustainability?
So politically, we might be seeing a push away from sustainability. But what I would tell you is sustainability has correlated with real estate demand trends forever. And a great example I could give you is when you take a tour of an office building, uh, what employers and landlords want to focus on is correlates with better sustainable assets, airflow, sustainable, more efficient energy needs inside that building. That's going to allow for less of an elect bill for the underlying tenants. When you have better airflow and better light from a sustainability standpoint, what does that lead to? That leads to better productivities for the employees that work in that building. And so these are just correlating trends between demand, what the tenant wants, and over time, that's going to lead to better pricing power or rental growth for those underlying assets. And that same thing can be true for retail assets, residential assets. And so that's why, in our view, understanding the benefits of or the benefits within a business model from a sustainability perspective, and also the potential issues within a business model from a sustainability problem, understanding that and thinking about it within your investment process is important part of the overall investment process. And the last thing I would add is governance is definitely a big part of sustainability because you need to understand in terms of what the incentive metrics are for senior management and make sure they're aligned with minority shareholders such as ourselves.
That's interesting. I haven't heard many people bring the government's angle into the sustainability side of it. So that's pretty unique. I want to commend you on that. Um, Besides wondering where you're going to sit at MSG for the five-show run this summer, what keeps you up at night these days?
It's clearly geopolitical issues. It's not just geopolitical issues, but geopolitical issues that could result in some type of material inflection point in the capital markets. And that inflection point, the uncertainty around that inflection point is really what keeps me up at night. Now, what do I do to counter that? It's a function of understanding our intended and unintended risks for each of our strategies, have conviction in the underwriting of each of our companies, and being diversified across different sectors and regions. And that could minimize, but never eliminates that geopolitical risk. And also just keep think about that geopolitical risk in terms of, well, does this provide an opportunity set to have greater excess return from an investment standpoint?
Whether you've got $2 billion under management in REITs or you're a retiree putting in a few $100 a month into realty income or a dividend paying stock, what is something that investors should be thinking about when it comes to REITs that may not be top of mind right now to a lot of people? What's something that's basically off the books that someone should be thinking about if they're not already?
Well, if they're not already thinking about uh, kind of capital allocation track record by senior management. So let me take a step back. Management quality and everyone always thinks about asset quality. And asset quality is paramount, very important. But management quality, in terms of understanding a management's track record from a capital allocation standpoint and an execution standpoint, that's very, very important. Understand that that management team is going to do the appropriate actions based on where that company is situated in the cycle, and having the confidence behind management is paramount, is very important, because different backdrops can change over time for a sector and or a company, and you want to have confidence in that management team doing the appropriate action for their shareholders.
Let's do a bolt on. If you could offer a piece of advice on REIT investing to someone, what would you tell them?
Don't let recency bias drive your decision process. And what does that mean? So some people, they look at listed REITs and they think about, oh my God, look at listed REITs performance relative to the equities over the last 6 years since COVID. It's terrible. We've had one very, very strong year. That was 21. We've had other solid years, but relative to general equities, it's been terrible over the last few years, underperforming by 50% or so. I mean, on the global landscape, um, yeah, or so. But don't let recency bias drive that because there are a lot of capital market volatility, inflationary pressures that occurred and are likely behind us. And so going forward, what is that? What has happened? Listed real estate now has reset those values and now can move forward and focus on fundamentals. And fundamentals are steady and improving. And that should result in steady total return performance going forward, similar to where we were prior to COVID. And by the way, those steady fundamentals, there's a lot of confidence in that. And it goes back to what we were talking about at the beginning of the conversation. The confidence comes from very little new supply, commercial real estate supply in today's market. And so that allows us to have confidence in demand being greater than supply in the next several years.
So I guess to put a little pretty bow on all of this, the value proposition of investing in REITs in this year and beyond, is it primarily driven by the lack of new supply, or is there more drivers there?
That's number one. Number two, relative valuation. And then three, when you think about demand, demand is steady. Demand is steady and improving in many sectors. And so it's really a combination of all of it.
Well, I have to say, this has been a very informative hour of conversation. If we were having this conversation 2 days ago versus today, I think the sentiment and mood would be much different. But as you said, with you know, ignoring recency bias, focusing on long-term fundamentals, the drivers that are in place to grow these companies in this sector. I'd like to hope that when we revisit this conversation a year from now, that we can look back and say, yeah, see, it played out like we thought it was going to. Just, play the game, stay with it, and that which comes around will eventually come back. So, on behalf of the entire audience that's out there, that's listening, watching this, down the road and everything, I want to thank you again for spending an hour with us, sharing some insights into how American Century views the world of REITs. So I can't thank you enough, Stephen.
Thank you very much, Dave. Appreciate the time you're doing.